John, how did you read that press conference?
Extremely dovish, David. There's no other way of putting it. I'll condense the meeting, the whole 1 hour press conference, into maybe 3 lines. Downside risks to growth inflation. They're going to re-examine the degree of stimulus needed, and some members wanted it now. What more do you want? I think the market reading this as this is rubber stamped for December. It's now just a matter of what they're actually going to do.
Brendan, weigh in.
Yeah, I mean, he said twice, John, it's not wait and see for December. It is look, work, and assess. And so he actually said they're actively working on figuring out how they would change QE. But also what stunned me was he actually actively talked about lowering the deposit rate even farther below zero. He said they're looking at other central banks for their experience, and we know that Sweden and Denmark have actually had negative rates for a while. There haven't been massive outflows of deposits, so they're clearly taking that on board, trying to figure out whether that's an option. He said, we didn't discuss it before, we did discuss it now. He even leaned into that statement to make sure we got the message. Everything is on the table, not just an extension or an alteration of QE, but also negative rates. That's a huge change from the last.
Brendan, Erik is San Francisco. Only he's allowed to lean in Cheryl country. Erik?
Well, clearly, Draghi could not have hinted more strongly that the ECB is on the cusp of more accommodative policy, and said that some members of the Governing Council wanted to be more accommodative right now. And as John pointed out, markets have responded accordingly, with the euro weakening rapidly, the German 2-year Bund dropping to a record low yield. This is what you would expect to see happen. I want to point out a couple of other things. I was really surprised to see a question about the migrant crisis come so late in the press conference. And Draghi's final point on that is probably the most important one. He believes that the Eurozone can deal successfully with a humanitarian crisis of unprecedented size. And the other thing is this the dissonance, if you will, about China. Remember, Draghi was talking about the resilience of the Eurozone economy. On a domestic level, he's effectively saying that monetary policy is working. It's helping to counteract the economic cycle, and the Eurozone economy on a domestic basis is actually performing quite well. And he pointed at the Chinese effectively for creating the problem. Emerging markets, but in particular China, are causing growth and inflation to slow. And that's very, very difficult to reconcile with the 6.9% GDP growth that China says it had in the third quarter.
John Ferro, I want to see whether you caught the same change in tone that I did. Vitor Constancio, the vice president, said, you know, they're not just worried about negative inflation, they're worried about long-term negative inflation. And they used to just have this automatic reflexive response, we're worried about runaway inflation. They're not only not worried about runaway inflation, they're actually worried about us spiraling into deflation. I thought that was an extraordinary change of tone.
It was, Brendan. There's actually a deeper read across, because what Draghi did discuss is that headline inflation shapes inflation expectations. And he also pretty much said that oil shapes inflation expectations. Now, that whole good-bad argument, whether a lower oil price is good or not, they're looking at the headline inflation rate and what shapes it, oil and an exchange rate. And this meeting, this news conference, also re-emphasized how important the FX channel was to stimulate this economy and get inflation back towards target. Euro-dollar back to 111.82. The moves in the bond market quite remarkable. A German 2-year with a yield at an all-time low, and spreads tight, tight, tight. Germany versus Italy back below 100 basis points once again. This was a firm news conference from President Draghi, and markets have reacted accordingly, as Erik says.
Yeah, one of the things that we were looking to before the conference is if he's talking about inflation, then he sees a downside risk. If he's talking about the growth in credit, then he's not that concerned. He barely touched on the growth in credit, yes. And there was a long segment, answers to many questions about the nature of deflation, how they're concerned about it, what causes it.
Yeah, and the role of oil specifically,
right.
Actually, as John Ferro said. The other thing that did strike me is there was a fair amount of talk about structural reform, yeah. Where he said, you know, we're not the only game in town. And there was the exchange with the German who said, boy, don't you have to do structural reform before you can really make progress on the monetary
classic
policy.
You know, you had a question from a German, don't we need structural reform? You had a question from someone from China, isn't China important to this trade relationship? Those are classic presser questions. But I also think that he said, Mario Draghi, before he said anything about structural reform, he pointed out out that infrastructure spending, that was his first ask from the politicians, not structural reform, but please, we need infrastructure spending. He couched it in, yes, it will raise potential, but also when you do a lot of infrastructure spending, it creates jobs, classic Keynesian stimulus.
Yes, but again, now you have to get 17 different countries on the same page, and that's very difficult to do in terms of infrastructure spending.
You could just get one. If Germany would do infrastructure spending, that would make a big difference, and Germany is way behind on its infrastructure spending.
Matt Miller.
Brendan brings up credit, and I know that he has graphed this, but I put it together with, in the white line here is the ECB balance sheet. The green line here is German inflation. Now, if you just look at those two lines, you can see that when we get a significant amount of QE or bond buying, you had gotten increases in German inflation here as well. But here it's petered off. They continue to increase their balance sheet, but they aren't getting any traction as far as boosting inflation. But Brendan's point is a good one. They are still getting traction as far as credit. This is EU money, M2 money supply. So they're still able to boost credit. They just can't really do anything about prices. Even if you get more QE, the question is, will that actually do anything to improve the green line in this chart?